I want to start today with a very specific image.
Yeah.
I want you to picture a standard Tuesday morning.
Okay.
You're sitting at your kitchen table. Maybe you've got a coffee. Sunlight is coming in, and you do what we all do. You grab your phone and open your brokerage app.
Right, the daily ritual.
Exactly. Maybe it's Fidelity, maybe Robinhood, whatever you use.
Mm.
You look at the screen, and the numbers, they look fantastic. The S&P 500 has just cracked 7,000.
Yeah.
You see green percentages literally everywhere. Your portfolio is up, say, 12% year to date. You feel this wave of relief. You feel smart. You feel secure. You think, okay, the system works. I'm making money.
And that specific feeling, that warm, fuzzy sensation of safety and financial competence, that is the single most dangerous emotion in the financial world right now.
I had a feeling you were going to be the buzzkill today.
That's what I do.
But to be fair, we aren't just being contrarian for the sake of it. We're looking at a stack of documents today. And I mean a literal stack. I've got about 200 pages of a file right here in front of me. And it frames this exact moment in history, early 2026, as a trap.
It is a trap, but not in the way people think. It's not a trap in the sense of a market crash where everything goes to zero tomorrow. That's what everyone is looking for. Everyone's waiting for 2008 again. This briefing implies something much more subtle and, honestly, a lot more painful.
Right. Let's set the stage a bit for the listener. This isn't a CNBC segment. We're doing a deep dive into a classified red team forensic assessment. And for the listeners who aren't in the intel or corporate strategy world, let's explain what a red team actually does. Because this definitely doesn't read like a standard JP Morgan outlook.
No, it's the exact opposite. In any high-level strategy, whether it's military or financial, you have a blue team and a red team. The blue team defends the plan. They tell you why everything is going to work out perfectly. The red team, though, they're hired to kill the plan.
They're the professional antagonists.
Exactly. If you run a family office or a sovereign wealth fund, you hire a red team to find the one loose thread that could unravel your entire billion-dollar portfolio. They look for the flaws that the blue team, which is essentially the consensus, is completely ignoring.
And the flaw this briefing identifies is absolutely huge. They call it the forensic discrepancy.
Forensic discrepancy. It sounds like a crime scene term.
In a way, it really is. It's a crime against purchasing power.
Mm.
And the discrepancy they found in this file is glaring. It's the gap between the paper world and the physical world.
Let's look at the numbers right from the summary page. On the left side, you have paper assets, stocks, bonds, up 12% on the year. Everyone is celebrating. The financial headlines are absolutely ecstatic. But on the right side, the cost of the outside world, things like energy, gold, physical copper, the literal stuff civilization is actually built out of, that is up 25%.
So if my stock portfolio is up 12%, but the cost of the things I need to buy, and more importantly, the cost of the things the companies I own need to buy is up 25%. Am I actually getting richer?
Mathematically, no. You are getting poorer. But psychologically, you feel richer because the nominal number on your screen is higher. That is the wealth mirage. And the core thesis of this briefing is that we are witnessing the great rotation.
A once-in-a-century structural shift.
Yes, where the smart money is fleeing the paper world to buy up the physical world.
Which brings us to the core concept of this whole deep dive. Inside money versus outside money. This is basically the intellectual engine of the whole assessment. It comes from the economist Zoltan Pozsar.
The plumbing legend.
Yeah, the man who understands the wiring of the global banking system better than perhaps anyone alive. He calls this shift Bretton Woods III. But before we get to the three, we need to understand the basic terms. Because I think for most people listening, money is just, money. A dollar is a dollar. Why does this distinction matter so much?
It matters because one is a promise and the other is a thing. And in a crisis, promises get broken. Things do not.
Break that down for us a bit more. What exactly is inside money?
Okay, think of it like a casino. This is probably the best analogy I've found. When you walk into a casino and you trade your cash for plastic chips, those chips are inside money. Inside the casino, they work perfectly. You can buy drinks, you can place bets at the blackjack table, you can tip the waitress. They function entirely as money. But what are they, really?
They're a liability of the casino.
They're an IOU.
Exactly. Their value depends entirely on the casino has the cash to cash you out at the end of the night.
Yeah.
It depends on the casino staying in business, and it depends on the casino manager actually letting you cash out. If the casino goes bankrupt, those chips are just plastic souvenirs. If the bit boss decides he doesn't like you and bans you, those chips are instantly worthless to you. They have zero value outside that specific system.
So translating that to the global economy, inside money is what, U.S. treasuries? Treasuries, bank deposits, generic fiat currency. It's all a ledger entry. It's a promise from a government or a bank to pay you. It relies 100% on trust. Trust that the government will exist, trust that they will pay, and trust that the currency they pay you in will actually have purchasing power. It exists purely inside the financial ledger system.
Okay, so what is outside money in this casino analogy?
Outside money is the cash in your pocket before you walked through the doors. Or, even better, it's the gold watch on your wrist.
The thing that has value regardless of whether the casino exists or not.
Correct. Gold. Oil, copper, wheat. These are assets that are absolutely no one's liability. If I hand you a gold bar, you don't need to trust me. You don't need to trust the U.S. government. The gold itself is the value. It represents final settlement.
And the red team argument here is that the world is currently walking out of the casino.
They aren't just walking out, they are running. And we know exactly when it started. The briefing points to a very specific catalyst, the trigger event, the weaponization of the dollar. We have to look back at the freezing of Russia's foreign reserves a few years ago.
We do have to touch on this. And look, regardless of your politics on the war, and we certainly aren't here to discuss the morality of the war itself, the financial act was completely seismic.
It changed global game theory forever. You have to look at this event through the eyes of a central banker in Beijing or Riyadh or Brasilia. They watched the G7 nations essentially delete the savings of a G20 nation overnight.
Because Russia's savings were primarily in inside money. They were sitting in Western banks.
Exactly. They were holding casino chips, and the casino manager said, we don't like what you did outside, so we are confiscating your chips.
So if you are Saudi Arabia or China, and you see that happen in real time, what is the lesson you take away?
The lesson is that U.S. treasuries are revocable promises, not absolute money. If you cross the issuer, your money is just gone. So these major export countries realized they had a massive structural vulnerability. They were holding all their national wealth in a form that could easily be weaponized against them.
So they initiate the Great Rotation.
They stop saving in promises, meaning treasuries, and they start saving in things. This is what Potzer calls Bretton Woods III. The first Bretton Woods was gold-backed. The second was backed by the U.S. dollar, and inside money, basically trust in the U.S. system. Bretton Woods III is backed by outside money, by commodities.
The source material here uses the term resource nationalism. Is that what we're seeing play out?
Yes, absolutely. It's the oil for gold or grain for tech dynamic. We're seeing major exporters demanding real, tangible assets in exchange for their physical goods. They don't want the paper IOU anymore. And the forensic evidence for this is undeniable. Just look at the central banks.
Yeah, the briefing says they are buying gold at the fastest pace since 1996.
They are hoarding. That's the exact word that the red team uses. They aren't just diversifying a little bit at the margins. They are backing up the truck. They are repatriating their gold, moving it from vaults in London or New York back to their own sovereign soil. They want physical possession.
Which implies a severe breakdown of trust. You don't take your gold home if you trust your neighbor to hold it.
Exactly. They are aggressively preparing for a system where paper promises are heavily devalued, so they need the only collateral that nobody can freeze or print more of, gold.
So while the retail investor, the person listening to this right now, checking their Robinhood account, is looking at their phone, seeing the stock market go up and feeling great, the central banks of the world are quietly acknowledging that the currency that stock market is priced in is losing its supremacy.
Which brings us right back to the wealth mirage. This is section 2 of our briefing. We really need to talk about the tax trap because this is where the everyday listener really gets hurt.
Yeah, there's a quote in the notes that hit me pretty hard. Nominal gains are the anesthetic they use to perform the surgery on your wealth. That is incredibly visceral.
It's a perfect analogy, though. Think about it. When the stock market goes up, you feel good. You feel sedated. You're happy. But let's actually run the math on this.
Okay, walk us through a concrete example.
Let's say you bought a broad market stock for $100. Over a few years, inflation runs rampant. The government prints trillions to cover deficits. The currency dilutes significantly. As a result, the stock price goes up to $150. You look at your account and say, great, I made a $50 profit. That's a 50% gain.
Sounds like a massive win on paper.
But here is the underlying problem. Because of the inflation, that $150 today buys the exact same amount of groceries or gas or housing that $100 bought when you first started. In real terms, in pure purchasing power terms, you haven't made a single penny. You just stayed flat.
Okay, so I haven't gained, but I haven't lost either.
Yeah.
I just treaded water.
No. Wrong. You lost. Because the government doesn't tax purchasing power, they tax nominal gains. They see that you bought at 100 and sold at 150. They see a $50 profit on their ledger. So they demand, let's say, a 20% capital gains tax on that $50. That's $10.
So I have to give them $10 right off the top.
Which leaves you with $140. But remember, you needed $150 just to break even on your purchasing power. You are now $10 poorer in real terms than when you started the whole process.
That is the surgery.
That is the surgery. You have been surgically separated from your wealth while you are completely sedated by the rising green line on your app. That is the trap. And the dumb money celebrates the new high, while the smart money is absolutely terrified of the devaluation required to keep those numbers going up.
This connects directly to the concentration risk too, right? The Mag 7. We've been talking about the Magnificent Seven, Apple, Microsoft, NVIDIA, and so on for years now. It feels like they are the only game in town.
And here in 2026, they are still the dominant media narrative. But the red team assessment calls this the concentration trap.
How so?
It's the law of large numbers. These companies have become so massively bloated that they simply cannot grow their actual earnings fast enough to outpace the debasement of the underlying currency. But more importantly, if 30% of your portfolio is in just 7 companies, you aren't an investor. You're a hostage.
A hostage to what exactly?
To productive overvaluation.
Yeah.
You are holding the most crowded trade in human history. Everyone owns these stocks. Every passive ETF owns them. The global pension funds own them. And as we aggressively shift to a tangible asset regime, the value is flowing out of pure software and into the physical inputs.
Okay, this is the perfect pivot point for us. Because usually when people hear someone say, move out of tech and buy commodities, they just roll their eyes. They think, but tech is the future. AI is the future.
Yeah.
Why on earth would I buy a rock when I can buy a neural network?
It's the classic objection. And let's be clear, this briefing isn't saying AI is over. Not at all.
Right. It's not a Luddite argument.
Exactly. But it's saying the nature of the AI trade has changed completely. This brings us to Section 3 of the file, the AI energy pivot.
From code to copper.
Precisely. Think back to 2024. The entire AI narrative was about chatbots. It was about software, LLMs, who has the best generative model. It was all digital hype. But now, in 2026, the physical reality has finally set in. AI is not a cloud. AI is a furnace.
A furnace.
It's a thermodynamic beast. That is the unavoidable physics reality. We kind of ignored this in the early hype cycle because software feels invisible. But a single high-end data center now consumes as much power as a mid-sized American city. We are talking gigawatts of power.
I've actually seen reports on this. The grid strain is very real. I read somewhere that a single complex ChatGPT query uses something like 10 times the electricity of the standard Google search.
Depending on the model complexity, it can be 20 or 30 times. And that's just for the query. Training the models from scratch is exponentially more intensive. It's an energy black hole. And here is the core problem the red team identified. The grid cannot handle it. Our public grid is ancient. It's creaking under the pressure.
So if you're a major tech giant and you have this incredible trillion-dollar AI model, but you literally cannot plug it in,
then you have a very expensive paperweight. So the smart money has realized a fundamental truth. If you own the code, you're competing with 1,000 other heavily funded startups. It's a brutal dogfight. But if you own the power that runs the code, you have a monopoly.
So capital is rapidly moving to the physical gateway.
Correct. We are tracking 3 main pillars of this digital infrastructure build-out. The first is the energy moat.
This is where the microgrids come in, right?
Yes. Big tech companies, the Amazons, Microsofts, Googles of the world, they aren't relying on the public grid anymore. It's too unreliable and, quite frankly, too dirty for their ESG mandates. They are buying nuclear power directly. Small modular reactors, or SMRs.
I saw those headlines. Google buying dedicated nuclear capacity. Initially, it sounded like science fiction.
It's just corporate survival. So the investment thesis in this briefing isn't necessarily by the software company. It's by the uranium miner or by the private utility that supplies the physical data center, owning the energy source that is physically decoupled from the strained public grid. That is the real moat. If the city goes dark, the AI keeps thinking. That is infinitely valuable.
What's the second pillar?
The material layer. This is where we talk about industrial metals, specifically silver and copper.
Now, I get copper. Wires, grid expansion, electrification. We basically need to rewire the entire planet. But silver. I always think of silver as, jewelry or granddad's coin collection.
That's a common misconception. Silver is the most conductive element on the periodic table, bar none. It is better than copper. It is better than gold. You want faster AI chips. You need silver. You want high voltage liquid cooling systems for these massive AI furnaces so they don't melt down. You need highly purified silver.
So as the chips get more powerful and dense, they intrinsically need more silver.
Yes. The briefing explicitly calls tangible AI a commodities play in disguise.
So if you're bullish on the future of AI, you practically have to be bullish on silver.
You have to be. You literally cannot build the physical infrastructure without it. And yet, look at the market valuations today. The tech stocks are priced for absolute perfection. They are trading at 50, 60, 70 times future earnings. The silver miners, on the other hand, are priced like dirt. They are trading basically at their production cost. That discrepancy is the rotation opportunity.
It's the arbitrage between the digital dream and the physical reality.
Precisely. And that leads us to the third pillar.
The sovereign vault.
This ties right back to the Bretton Woods III concept. If the world is fracturing into distinct geopolitical blocks, West versus East, where do you actually keep your data?
Well, not in a jurisdiction that might freeze it or seize it. If you are a massive global enterprise, you certainly don't want your core servers in a country that might get slapped with sudden sanctions or caught in a trade war.
Exactly. We're seeing a massive move toward data havens, neutral jurisdictions, Switzerland, Singapore, places where digital sovereignty is enshrined in law.
It actually reminds me of that offshore trust loophole we discussed a while back. I think it was Deep Dive episode 142, the intersection of legal protection and absolute physical security.
It's the exact same underlying principle. The capital is flowing to places where the inside money rules, like sanctions and asset seizures, simply don't apply. So the great rotation playbook is this. Sell the software, which can be copied or heavily regulated. Buy the energy, which is critically scarce. Buy the metals, which are geologically finite. And secure the jurisdiction, which is sovereign.
It's a K-shaped rotation.
Yes. Visualize the letter P. The top arm goes up, that's the wealth flowing to owners of physical inputs. The bottom arm goes down, that's the slow bleed for the holders of pure paper stocks. If you own the tech stock without owning the underlying resource required to run it, you are slowly being diluted by the technology itself.
Because the tech company has to continually pay more for the electricity, more for the copper wiring, more for the silver and the chips. Their profit margins get brutally crushed, while the commodity producer just sits back and sees their margins expand.
Exactly. They hold the leverage.
Okay, I'm going to play devil's advocate again here. This all sounds very logical. It makes for a great story. But is it actually happening in the real world right now? Or is this just a theory, a sort of doomsday red team scenario that might happen someday?
That is exactly why Section 4 of the briefing is titled The Evidence. We have the CRA, the Capital Rotation Assessment.
What's the score telling us?
The CRA score is currently at a decade high. But the most damning piece of forensic evidence they present is the breakdown of the historical correlation between gold and the S&P 500.
Usually they move in opposite directions, right? Or at least they used to. The old rule was risk on, buy stocks. Risk off, buy gold.
Historically, yes, that was the trade. Or they kind of just drifted independently. But in early 2026, we saw a massive snap. Gold fundamentally broke its two-decade correlation. Think about it. The S&P is cracking 7,000. Gold is pushing aggressively past $3,000. They are both rising at the same time.
What does that tell a macro strategist?
It tells you the market is finally sniffing out the currency debasement. When stocks and gold rise simultaneously in a sustained way, it usually means the denominator, which is the dollar itself, is failing. It takes more dollars to buy the share of stock, and it takes more dollars to buy the ounce of gold.
So the stock market isn't necessarily going up because companies are suddenly selling way more widgets. It's going up because the dollar is just worth less.
Exactly. But the smart money interpretation of this is even more specific. They see institutional capital quietly moving from productive overvaluation, meaning overhyped tech, to scarcity undervaluation, meaning physical commodities.
So the big funds are already doing exactly what this briefing suggests.
We call it the institutional playbook. Look at what the Wall Street giants are actually doing with their capital, not what their analysts are saying on television. They're actively selling software holdings to buy hardware. And I don't mean computer hardware. I mean physical mines. I mean water rights. I mean strategic energy reserves.
They're buying the board game, not the pieces.
That's a great way to put it. And the sense of urgency in this document is completely palpable. There's a line that says, "This is a migration, not a speculation."
What's the distinct difference there?
A speculation is, hey, I think this particular stock will go up over the next quarter. A speculation is entirely optional. A migration is the environment we are living in is becoming structurally uninhabitable, and we need to move our capital to safer ground immediately. A migration is mandatory if you want to survive the winter.
That brings us perfectly to the verdict, the so what for the listener. Because most people listening to this right now aren't managing a billion-dollar sovereign wealth fund. They have a 401k. They have an IRA. They have some personal savings they've worked hard for. How do they actually position themselves for this tangible regime?
The 2026 filter is the fundamental question you have to ask yourself when looking at your net worth. Am I an owner of promises, or am I an owner of things?
And if the honest answer is mostly promises, say my portfolio is 90% S&P 500 index funds and 10% municipal bonds,
then you are deeply vulnerable. You are heavily exposed to an inside money system that is currently under siege. The briefing offers 3 strategic directives to fix this imbalance.
Let's hear them. Directive number 1.
Stop chasing the index. Reject the S&P 500 as a definitive safe haven.
Man, that is tough advice for a lot of people to swallow. We've all been trained for 40 years that buy and hold the index is the golden rule of investing. Warren Buffett preaches it. Every financial advisor says it.
And it works beautifully in a stable currency regime. It works perfectly when inside money is universally trusted. But in a Bretton Woods III world, the broad index is a dangerous concentration trap. You are essentially buying the past winners. You are buying the Mag 7 at their absolute peak valuation. You are blindly buying into the paper bubble.
Okay. Directive number 2.
The 15% tangible rule. This is emerging as the new standard for smart money, moving at least 15% of the total portfolio into physical, vaulted precious metals and high-quality commodity-linked equities.
Note the specific words there. Physical and vaulted. So not just buying a paper ETF on an app.
If you can help it, absolutely not. Remember the core distinction. An ETF, like the popular gold ones, is still inside money. It is merely a paper claim on gold. It inherently involves counterparty risk. If the financial system freezes up or the broker goes under, your ETF is frozen. Physical metal, securely stored in a private vault, is outside money. It doesn't rely on any counterparty remaining solvent.
So you actually own the physical metal, and you just pay a facility a small fee to store it safely. It's completely off the digital grid.
Correct. It's your ultimate insurance policy against the ledger system failing. And directive number 3.
This one feels very psychological.
Watch the ratio, not the price. This is absolutely crucial for maintaining your sanity during this rotation. You have to stop looking at the dollar price of gold and thinking, oh, gold is $3,000 an ounce. That's way too expensive. I missed the boat.
It does sound intuitively expensive. $3,000 is a lot of money for a small coin.
It's completely irrelevant. If the underlying dollar is collapsing in purchasing power, $3,000 might actually be incredibly cheap. You need to focus on how many ounces of gold it takes to buy the S&P 500 index.
The Dow to gold ratio, or the S&P to gold ratio.
Exactly. Start using gold as your permanent ruler, not the fluctuating fiat dollar. When that ratio drops, meaning it takes progressively fewer ounces of physical gold to buy the entire stock market, you know for a fact the paper mirage is fading. You know that real systemic wealth is migrating to the tangible side. That specific ratio is the ultimate truth teller in this environment.
I can hear the counter-arguments forming in people's minds already. We briefly touched on it earlier, but let's hit it harder because it's the most common pushback. Isn't paper wealth inherently safer over the long run because it's tied directly to human innovation, human ingenuity? A gold bar is just a dumb rock. It sits in the dark. It doesn't yield anything. It doesn't cure diseases. A company like NVIDIA is full of thousands of brilliant geniuses actively creating the future. Shouldn't I always bet my money on the geniuses?
That is the classic argument. And in a total vacuum, it is absolutely true. Innovation obviously creates massive value. I am not anti-tech, and this briefing is not anti-progress. But innovation fundamentally requires physical inputs. In a severely resource-constrained world, which is exactly what Bretton Woods III dictates, the input providers hold all the critical leverage over the innovators.
You can have all the tech geniuses you want in a room in Silicon Valley, but if you don't have the steady baseload electricity to turn on the supercomputer, you effectively have nothing.
Precisely. The leverage dynamic has fundamentally shifted. The red team forcefully argues that for the last 40 years, the real power lay with the intellectual property, the software code, the global brand. But for the next decade, the power lies firmly with the physical property. The copper mine in South America suddenly dictates terms to the chip manufacturer in Taiwan. The nuclear power plant dictates terms to the hyperscale data center.
It's a massive shift from the intangible economy right back to the tangible economy.
It's the revenge of the real world.
The revenge of the real world. I really like that framing. So let's summarize the key intelligence we've unpacked here today. We are sitting in early 2026. The stock market is printing all-time highs, but it's largely a nominal illusion that's masking a severe ongoing decline in actual purchasing power.
Correct. That is the wealth mirage in action.
The global system is actively fracturing into inside money, which relies on Western debt and trust, and outside money rooted in tangible commodities. And this was all triggered by geopolitical shifts and the blatant weaponization of the dollar reserve system.
Yes. That is the essence of Possar's Bretton Woods III.
And the really smart money is aggressively but quietly rotating out of pure tech and paper assets and moving heavily into the energy, the metals, and the physical infrastructure required to actually sustain this AI-driven future.
That is the entire forensic briefing in a nutshell.
The greatest danger to the listener right now is just being comfortably sedated by that rising green line on their phone screen.
And the only real solution is to move proactively with the capital, to transform from an owner of promises into an owner of things.
I want to ask everyone listening to do a quick mental audit right now. Look closely at your current holdings. Do you own the physical mine, or do you just own the paper share of the mining company? Do you own the physical gold or the digital ETF? Do you own the actual land or just a piece of a massive REIT?
The closer you can get your wealth to the physical base asset, the safer you are going to be in this macro transition.
And for those out there wondering about the actual legal mechanics of holding these tangible assets safely, we highly recommend revisiting our deep dive on the offshore trust loophole. It pairs perfectly with today's briefing on the structural and legal side of things.
Absolutely it does. Asset selection is only step one. Asset protection is step two. You urgently need the right legal structure to hold your outside money so it remains completely outside the system.
This has been an incredibly intense deep dive. It's a very different way of looking at the financial world. It's not really optimistic or pessimistic, is it? It's just physics and math.
It's purely forensic. It's looking coldly at the capital flows, not the media narratives. Narratives constantly lie. Capital flows do not.
I think there's one final thought I want the listener to really mull over today. Think about what happens when the broader public finally wakes up to this mirage. By the time this massive capital rotation is finally breaking news on CNN or being discussed openly at your neighborhood barbecue, the smart money has already positioned themselves and securely locked the vault doors. You not want to be the last one trying to buy a seat on the lifeboat.
Exactly. Once the panic over purchasing power hits the mainstream, the price of these physical inputs will be completely untouchable for the average person.
I'm going to leave you with the final directive straight from the Red Team file. It's a heavy line, but I think it perfectly sums up the absolute urgency of this entire assessment.
The Great Rotation is not a prediction. It is a migration already in progress. Position accordingly.